Hey everyone, thanks for joining me. I wanted to go over three investing mistakes that we commonly see folks make, or at least the research gets behind this. And they're mistakes that are easy to make, and we want to help give you direction to make sure that you don't make them as well. There's behavioral biases that underlie them, though. So the challenge that you have to overcome in not making them is making sure that you have an investment plan and a methodology and approach that you're adhering to preserve the discipline that's necessary really to do well in investing. So before I share the mistakes, I just want you to make a point to subscribe to our newsletter, and our YouTube channel, and be sure to follow us on LinkedIn and Facebook. We're here to do what we can to give the best financial guidance and advice to you, our listeners. So really appreciate you tuning in with me today. The three mistakes. One of the big ones is this notion of timing the market. We all can get maybe a sense that maybe a recession is upcoming. It's not just a sense, maybe the data is supporting it. There's leading indicators that can be followed. And so, naturally, if we think maybe the market's going to pull back, if there's a contraction in the economy, it's like, well, why right through that? Why don't I go ahead and, if the money's at this point has these current valuations, why don't I go ahead and move that to cash, to something that's safer, allow the market to take the dip and then bounce back into the market once things seem to have recovered. And though on the face of it, that sounds like a great idea, let's do that. And quite frankly, if you could do that and you could do it successfully, it would be a great idea. Let's kind of cut all these low ends out of our portfolio and not necessarily see the bottoming out. The challenge isn't maybe that we have here is it's twofold. One is it's to know when to pull out of the market, but two, it's knowing when to go back in to the market. And what will commonly happen is maybe people's sense of when to pull out of the market is correct, not perfect, but maybe correct. The problem is their sense of knowing when to get back in is almost always off. And that's because the market tends to respond rather quickly in terms of a bounce. And you have to really, in order to make sure that you don't lose out on that bounce, especially if we've sold out here and we're wanting to buy down at the bottom and get back in and maybe profit from the gain, that spread. You have to know when to put the money back in, and usually the smoke hasn't fully cleared. It's a little scary yet in the marketplace, and so you're too hesitant because you don't want to see the market pull down even further. You don't know when that bottom's really bottomed out. And because of that hesitancy to be like, okay, now's the time to go back into the market, and then because the bounces tend to be rather fast, people miss out. And instead of catching it back at maybe at the same point, the worst case scenario is they can wait until they get really confident that the market's back, and they actually lose money because they sold here and now they're buying back at here at a point that's even higher. And so trying to time the market, the best expression for this is don't try to time the market. Just it's not time. It's not timing the market. It's time in the market is the expression. Highly recommend that practice and that approach. And missing out on these recoveries, which are associated with these lows, can really be an enormous loss of wealth. We have a chart that you can take a look at and see for yourself. Another common mistake that we see folks making is focusing too much on the headlines, or maybe chasing, a hot stock tip. They starting to hear of a company and it's, grabbing some attention, and you're like, oh, well, this seems like a good deal, and everyone's talking about it. And so, shoot, if everyone's talking and thinking about it, and listen to all the press it's getting, it seems all so positive and affirming. We should buy it too. Like, what could go wrong? Everyone has such a positive attitude towards this. And although that can all be true, all these, this momentum, this sense of like, hey, buy this company. The problem is that by the time you're buying in with all that knowledge already out in the marketplace against buyers and sellers, and you not being the only person who's heard this news. In fact, tens of thousands, maybe hundreds of thousands, perhaps even millions have heard this news. By the time you buy that stock, the price has already baked in all that information, and it's being captured. And the price that you're paying, they're aware. The people who are selling you the stock are aware of all these good things. And so, investment returns are really driven by how much, are you paying for the expected earnings, future cash flow that this investment is expected to provide. And at the end of the day, even if the company is fantastic and they're great and they do really good things and everyone loves them, and let's say they just run, it's a perfect company, it runs really well. just simply owning that in and itself does not make for a good investment. It's the price associated with this perfect company that makes for the good investment. And so if the price is too high or has gotten to be too high because of all the hype and all the attention and the excitement with it, even if the company's fabulous and great, like the investment, it as an investment can stink and not be good for you at all or be just terribly flat. And so, you'll see this in the biggest of companies where they're garnering all the attention. And the truth is, they get all the attention now because their stock performance up until, they've really peaked has been amazing and everyone wants a piece of that. But, their stock performance post peak tends to be very flat, if not negative. So we have a chart to show and share here too. And so this is, basing your investment decisions off of what's, in the latest news is almost certainly not going to work well for you because it's not recognizing that stock price has captured all that news already. And so you're really, what's happening is you're just buying too late. I mean, it's great that you got the news, but you needed to have bought, before all the news came out. You're now buying after all the news came out. And there's a really big difference between before the news and after the news. And that kind of decides the whole thing, really decides risk at the heart of it. It's much safer of an investment when you know all about it. But look, there's risk and reward here, folks. And if it's starting to be really super easy and feels low risk and it's just guaranteed money, it's probably not true. We gotta have a sniff test on this. Probably just not going to work. The third thing that we'll see is moving away from perhaps individual companies or individual securities. We were talking timing the market. We're trying to chase headlines. Hot stock tips. Now it's a third piece is chasing performance. This notion is the idea that we can see, maybe an ETF or a mutual fund, or it could be an individual company, but these tend to be more of what's called a pooled investment. Um, it's done really well, and perhaps it's beating the index. It's doing better than everybody else. And you're like, man, I want a piece of that too. I don't want just some investment that's doing okay or doing the index, or shoot, even worse, it's doing lower than the index. Like, why be invested in that? That actually could make a lot of sense to be invested in that as an example to kind of show you the paradoxical nature of investing. But we want the thing that's done really well because we find, again, security in this. And looking to the thing that's done really well, the problem is that just because a fund, a pooled investment, it's usually being run by a fund manager and has all these underlying investments, companies that have been bought into, you have two things that are in play. One is, past performance is no guarantee of future performance. But also it's, so if something's done really well, it doesn't mean it's going to continue to do well. And in fact, the studies, we have yet another chart for you to take a look on this. The odds are actually pretty unlikely. It's probably 1 out of 4, 1 out of 5 chances that something that has done really well will continue to do well. There isn't security. There's not as much security in it as you think. Just because it has been doing well doesn't mean that's going to persist. And in fact, actually, if there's anything, if the odds are 1 out of 5, which is what the research would suggest, maybe 1 out of 4, if anything, buying into it actually means you're basically buying high. And it's what's going to happen is you have this fundamental dynamic called the reversion to mean, in which things, in order for the average to be what it is, if something is this high, it can't perpetually stay this high or even continue to go higher, because otherwise it would start to push the average higher and higher. And so for something to consistently be better than the average, the suggestion is, at least statistically, is that rather than staying or even going higher is less and less likely, the more probable outcome actually is for it to come back down towards the average, because ultimately the average is what it's been made up of, and, if this is where the average is at and something's above average, the odds that it will continue to stay above average are actually not favorable. And so, if you were looking for top performance and you buy into something that's been performing well and in hopes that it will continue to perform well, what you're actually basically doing is just buying into something at the peak of its price. And what you're going to likely see, not guaranteed, we don't know these things, but statistics can give us some assurance as to what we think may happen in the future. What we're likely to see actually is it's going to go down and revert back to what the average is. And then, that may not be a bad thing, because you could ride through that. And then look, things tend to go back up too. It's not always down. But you have to be willing to continue to ride. And if you bought this because you wanted it to do well, now you start to see it lose money, uh, and all you're doing it was because you thought it would continue to do well or even go higher, your investment plan isn't strong enough. Your investment discipline isn't probably strong enough for you to stay through that downturn. And your inclination is to, oh, I got a stinker. This has turned into a lemon. I'm going to cut this and lose. And we get into this weird dynamic that we know rationally like doesn't make any sense, and yet behaviorally we see it still persist. And that's this issue where people buy high and sell low. And like, you don't make money that way, right? You're supposed to buy low and then sell high. But people in the research, at least the folks who do this, uh, seem to suggest like, actually what people will tend to do is they'll keep buying high and selling low, and why. And so chasing performance is one of them. The headlines piece, though, is part of this. And then timing the market, they all come together to get you into trouble. So hope you've gathered a few tips and benefits from this video. If you're not working with an advisor and you're kind of thinking of maybe I could use one or benefit one, please reach out. We'd love to have a call with you and see if we can't, work out an engagement that makes sense for all parties. Be sure again to subscribe to our newsletter and, subscribe to the YouTube channel. We'd love to have you guys following and listen in, and just keep tuning in. We're shooting, turning out content, and we're wanting to produce something that you all very much appreciate and like. So until next time, we wish good things for you. And if you got any ideas, contents, or topics that you're like, hey, I'd like to hear a little more about this, shoot it our way. We'd love to hear what's on top of the top of your mind as well. Thanks so much.